Today's material is a financial script analyzing the structural drivers, like staking yields, network utility, and institutional ETFs that could cause Ethereum to outperform Bitcoin in 2026.
Mm-hmm.
And let's just dive right in. Let's look closely at the section discussing the overall structure and how the piece handles its central thesis versus the potential downsides.
Yeah, that stood out to me right away.
Right, because the author lays out like 6 distinct bullish drivers right up front, but then they sequence this completely isolated, separate list of risks at the very end of the text.
Yeah. The current structure isolates the asset's strengths from its vulnerabilities, creating a disjointed narrative that weakens the overall analytical impact.
It really does.
I mean, by grouping all those bullish catalysts into one continuous section and then just burying the risks, things like layer 2 cannibalization or high macroeconomic correlation.
Way at the bottom.
Exactly. At the bottom of the document, the listener just does not receive a fully balanced picture of each concept in real time.
No, they don't.
The analysis feels compartmentalized rather than holistic.
Yeah, and that compartmentalization, it creates a massive psychological disconnect for an advanced listener.
Oh, totally.
When you present an expert audience with just unmitigated strengths for 10 straight minutes, their internal skepticism fires up immediately.
Right, they start looking for the catch.
Exactly. If I am listening to a deep dive on, say, network utility, and I don't hear a single mention of potential drawbacks, my first assumption isn't that the asset is flawless.
No.
My first assumption is that the author might not know the drawbacks even exist.
Yeah, you hit on the underlying mechanism of how experts consume information there. They aren't waiting for the conclusion to think about downsides.
Right.
They are mentally raising objections the very moment a catalyst is introduced. It's like they're running a shadow argument in their head parallel to your script.
That is exactly what it is, a shadow argument.
Yeah. So the suggestion here is to integrate the specific risks directly into their corresponding catalyst sections to create a more sophisticated, multi-dimensional argument as each point is introduced.
Okay, I like that.
Rather than a list of pros followed by a list of cons, the script must weave them together to disarm that internal skepticism on the spot.
So how would that look in practice? Because if we look at point 2 in the current draft, the material discusses Ethereum's utility and the surging demand for gas to execute smart contracts.
Right. And that is the exact moment to introduce the counterbalance.
Right there in point 2?
Yes, address the reality that Layer 2 networks, while processing incredibly high transaction volumes, might actually siphon base layer fees, which creates a deflationary headwind for the main chain.
Ah, I see.
Because if you wait until page 10 to mention Layer 2 cannibalization, the expert listener has already spent 5 pages doubting your understanding of the ecosystem scaling roadmap.
Yeah, they've already tuned you out. And the author does something really similar with the staking yield in point 3. They outline the 3 to 3.5% native yield as just a pure catalyst.
Yeah, and instead, they should address the governance risk of potential yield reductions right there in the same paragraph.
Right.
When you confront the vulnerability of the yield in the same breath as its strength, you demonstrate absolute command over the subject matter.
Yeah, you showed the audience that you understand not just how the engine generates power, but exactly where the thermal stress points are located.
That's a great way to put it.
This structural choice, it actually reminds me of a corporate prospectus.
Oh, yeah?
Yeah, it reads like a management team pitching a company's massive revenue growth in Chapter 1, but deliberately hiding its crippling operating costs until a footnote in the appendix.
Right, hoping nobody reads that far.
Exactly. And when the audience finally hits that risk section at the end, the sudden shift in tone almost invalidates the enthusiasm that was built up earlier.
It really does.
But from a writer's perspective, I can understand the hesitation, right? I mean, financial commentary relies heavily on momentum.
Sure.
If every time I introduce a bullish point, I immediately undercut it with a risk, there is a real danger that the script starts to feel pessimistic, or that I just kill the enthusiasm before the thesis even gets off the ground.
That makes sense. But could the evidence also support a different conclusion? Like, could the friction actually be a good thing? For an expert audience, the nuance is actually worth the pacing shift. An advanced listener does not want unchecked enthusiasm. They want rigorous analysis.
Right, they want to know you've done the work.
Exactly. The friction of the counterargument is what makes the primary argument believable. Friction creates traction.
Oh, friction creates traction. I love that.
Yeah, if you explain how Ethereum's utility is growing and then immediately contextualize the Layer 2 risk not as a death knell, but as a necessary evolutionary step in network scaling.
Mm-hmm.
You aren't slowing down the pacing, you are elevating the discourse.
It changes the tone from a sales pitch to an objective investment thesis.
Exactly. You trade superficial momentum for deep credibility. An expert will gladly listen to a slower, more deliberate argument if they feel the person guiding them has mapped out all the blind spots.
Right. So, mechanically, how does the author do that without sounding clunky?
They can achieve this by using concession-based transitions.
Okay.
Start the paragraph by outlining the gas demand and then pivot with a phrase like, while Layer 2 scaling inevitably cannibalizes some base layer fee revenue in the short term, the net effect is a wider funnel for aggregate network adoption.
Oh, that's really smooth.
Right? And then you just return to the bullish through line.
Okay, but even if the author integrates those risks smoothly, the way these integrated points are stacked presents another challenge entirely.
Yeah, the hierarchy.
Exactly. Looking at the notes, the argument treats these catalysts as 6 equal pillars. You've got the assets high beta, its on-chain utility, the staking yield, the deflationary supply dynamics, the institutional ETF inflows, and protocol upgrades like Denkin and Pectra.
It's a lot.
It is a lot, and they are laid out side by side, perfectly horizontal in their importance.
Yeah, the argument presents all 6 growth drivers as equally important, missing a crucial opportunity to build a compelling hierarchy of market catalysts.
Right.
Treating minor protocol optimizations with the exact same weight as multi-billion-dollar institutional ETF inflows, it just flattens the analysis.
It does.
The script currently lacks a central driving thesis about what the primary engine for the 2026 outperformance actually is.
Because when everything is highlighted as crucial, nothing is crucial.
Exactly. The listener is left with a highly informative encyclopedia entry, but they aren't left with a pointed, sharp thesis.
It's the difference between a listicle and an analytical framework.
Yes.
Like, a list simply tells you what ingredients are on the table, but a framework tells you which ingredient acts as the catalyst and which ones act as the accelerants.
That's spot on. The suggestion is to establish a clear hierarchy by identifying a primary overarching catalyst for 2026 and frame the remaining points as subordinate evidence supporting that main thesis.
Okay, so we need a primary driver.
Yes, you need to build a pyramid of causality, where one dominant event triggers a chain reaction through the network's underlying mechanics.
Let's construct a concrete example of how the author could restructure these 6 points into that pyramid.
Okay, so you frame the institutional ETF inflows as the undisputed primary argument for 2026 outperformance.
Right, so that goes at the very top of the hierarchy.
This is the top, exactly. Then you restructure the supply dynamics, specifically the EIP 1559 fee burn and the fact that 34 to 35% of the supply is locked in staking. You frame those as the subordinate, mechanical reasons why those institutional inflows will trigger a disproportionate supply shock.
Ah, okay. So instead of saying ETFs are creating demand and separately supply is burning,
Right.
the author needs to say ETFs are creating unprecedented price-insensitive demand, and that capital wave is colliding directly with a mathematically locked-up supply.
Yes. Suddenly the points aren't parallel anymore. They are multiplying each other.
That's so much more dynamic.
Right. Because the deflationary mechanics only matter if there is external demand to expose the scarcity, and once you establish that collision, then you bring in the historically low ETH to BTC ratio.
Which the script notes is sitting around 0.025 to 0.030, right?
Exactly. And do not leave this ratio as a floating disconnected section at the end of the document.
Yeah, right now it just kind of hangs out there.
Use it as the numerical proof of the setup. It acts as the pressure gauge showing how undervalued this exact collision of ETF demand and supply scarcity really is.
So a key theme running through this material seems to be the author's excellent use of institutional data, right? Like from JP Morgan and Standard Chartered.
Yeah, the data is very strong.
But I want to challenge this specific hierarchy, though, because it brings up a real thematic tension in the script.
Okay, let's hear it.
If we advise the author to elevate Wall Street ETFs to the absolute top of the hierarchy as the supreme catalyst, how do they avoid contradicting the script's foundational premise?
Right.
Because the core of the author's argument is that Ethereum wins because of its decentralized utility.
Right, the on-chain stuff.
Yeah. If the ETF is the primary catalyst, the phrasing could easily make it sound like centralized Wall Street banks are bailing out the decentralized world computer.
Is there a risk that focusing solely on the ETFs might overlook the fact that utility and institutional adoption are actually a feedback loop?
A feedback loop.
Yeah, the phrasing is incredibly delicate here, but framing it as a hierarchy actually solves this apparent contradiction. You establish that feedback loop.
Okay, walk me through that.
The institutional capital isn't arriving in a vacuum, right? It is arriving purely because of the decentralized utility.
Ah, I see.
Wall Street is allocating capital because the asset generates a native, decentralized yield that they just cannot replicate in traditional fixed income markets.
That makes sense in theory. But how does the author actually write that transition without making the traditional finance institutions the protagonist of the story?
Right, you don't want them to be the hero.
Exactly. If the ETF is the peak of the pyramid, Wall Street still looks like the savior.
Well, you position the decentralized mechanics as the prerequisite trap.
Oh, the trap. I like that.
You tell the listener, Wall Street is the catalyst for the 2026 price action, but the decentralized utility is the infrastructure that forced Wall Street to the table.
Oh, that completely flips the dynamic.
Yeah, the author can explicitly state the traditional finance isn't bailing out the network. Rather, traditional finance is finally being forced to interface with a superior automated settlement layer because they just cannot ignore the yield.
Right.
You structure it so that utility and the protocol upgrades are the foundational bedrock. They are the reasons the ETF capital is able to flow in safely.
So the on-chain utility creates an unavoidable gravitational pull, and the ETF is simply the vehicle that traditional capital uses to surrender to that gravity.
Exactly. And that interconnected hierarchy is infinitely more compelling than reading off 6 bullet points that do not talk to each other.
Absolutely.
It shows causality. It gives the listener a mental model they can actually use to evaluate the market. So when a new macro event happens tomorrow, the listener will know exactly where to slot it into this causal framework.
Okay, so we fix the structure, we fix the hierarchy. But even with a perfect causal hierarchy, the argument is still going to fall flat if the audience tunes out before the pieces actually come together.
Yeah, delivery matters.
It really does. In the introduction, the author explicitly states their goal is to keep things clear, professional, without getting bored, and they promise this dynamic analysis.
Right.
But the actual terminology used throughout the draft directly undermines that goal.
It gets pretty dense.
Oh, incredibly dense. We are looking at a thicket of phrases like in-kind redemptions, float, liquid staking tokens, EIP 155, and beta of 1.5.
Yeah, the script relies heavily on technical financial terminology without consistently anchoring these concepts in the vivid, accessible tone promised in the introduction.
It's just too much all at once.
While the audience is deeply familiar with crypto, rapidly stacking concepts like a beta of 1.5 to 1.8, EIP 1559 burn mechanics, and Bitwise's 65% variance models, it just creates a dense wall of text.
Right.
It tells the listener the raw data, but it completely fails to visually translate the mechanics of why that data matters in a visceral way.
There is a cognitive fatigue that sets in, even for a seasoned expert.
Oh, absolutely.
When an author forces the reader's brain to constantly decode highly specific jargon, they are draining the listener's working memory.
Right, they're working too hard to understand the words.
Exactly. The listener spends all their cognitive energy just parsing the definitions, leaving them with no mental bandwidth to actually evaluate the strength of the investment theses.
You lose the forest for the incredibly complex mathematical trees.
So true.
The suggestion here is to employ vivid, real-world financial analogies to bridge the gap between complex on-chain mechanics and the listener's intuitive understanding.
Okay, I can see what you're going for here. Let's see how we can strengthen this. We need to translate it.
Right? You need to map the unfamiliar or hyper-technical crypto concepts onto deeply familiar traditional finance concepts. This directly fulfills the author's promise of an engaging, spirited tone while preserving all that rigorous data.
We definitely need a concrete example of how to execute this translation layer. Because right now, the draft simply states that Ethereum has a higher beta and acts as a risk-on asset compared to Bitcoin.
Which is true but dry.
Very dry.
So ground that abstract statistical concept in a classic market dichotomy.
Okay.
Compare Bitcoin to a defensive, blue-chip stock
like digital gold with a hard 21 million cap, right? The kind of asset investors retreat to when macroeconomic conditions look grim.
Okay, so that's the baseline.
Then compare Ethereum to a high-growth tech stock, a programmable operating system that aggressively captures market share when risk appetite returns.
Oh, that makes so much sense.
Right? That immediately explains the beta of 1.5 without requiring the listener to visualize a regression analysis.
No math required.
Exactly. They intuitively grasp that when the Nasdaq rallies, tech stocks outpace gold.
And what about the tokenomics? Because explaining the interaction between the EIP 1559 fee burn and the staking lockup is notoriously dry.
It is.
It usually devolves into this purely mechanical explanation of base fees being sent to an unspendable address.
Which puts people right to sleep.
Totally.
So in explaining the deflationary dynamic of EIP 1559 combined with the 34 to 35% stake supply, do not just say it reduces the circulating float.
Right.
Describe the network as a highly profitable tech company that is simultaneously paying a 3.5% dividend to its active shareholders while aggressively buying back its own stock on the open market.
Okay. A dividend plus a stock buyback.
Right.
Anyone who has ever evaluated traditional equities understands exactly how explosive that specific combination is for price discovery.
They feel it instantly.
But I do want to push back on the use of traditional equity metaphors for decentralized protocols.
Okay, why is that?
Because some writers strongly resist this. They argue that using traditional stock market analogies to describe cryptographic networks is fundamentally inaccurate, and it sort of dumbs down the material for a crypto-native audience.
A crypto-native audience that prides itself on building a completely new financial system.
Exactly. They don't want to hear about stock buybacks.
It is a valid concern if the analogy is used as a crutch to avoid explaining the real mechanics.
Right.
But the author's deep expertise is already evident in all the data they have compiled. These analogies don't erase that expertise. They serve as the initial bridge.
A bridge, yeah.
If you tell a Wall Street analyst the network burns base fees, they might nod politely. But if you tell them it executes a perpetual share buyback driven by network revenues while offering a 3.5% native dividend,
You have their complete undivided attention.
exactly. You have taken a piece of dense jargon and turned it into an aggressive, undeniable value proposition.
But how does the author address this structural differences then? Because with a traditional equity buyback, a centralized board of directors is making a discretionary decision to purchase shares.
Right.
They can stop the buyback tomorrow if earnings miss expectations. With Ethereum, EIP 1559 is a programmatic, deterministic algorithm. It executes whether anyone wants it to or not.
Well, the author should actively lean into that exact contrast.
Oh, use the difference as a selling point.
Exactly. You use the traditional finance metaphor of the stock buyback to get the listener in the door, and then you immediately highlight why the crypto version is structurally superior.
Okay, how would you write that?
You write something like, it operates like a corporate stock buyback, but instead of relying on a CEO's mood or a board's quarterly vote, it is hard-coded into the deterministic physics of the network.
Oh, that is so good. The deterministic physics of the network.
Right? You use the familiar metaphor to set a baseline, and then you conceptually transcend it to highlight the unique strength of the asset.
That contrast is what makes the script compelling. It respects the intelligence of the crypto-native listener by acknowledging the differences, while simultaneously providing a brilliant framing device for any traditional finance listeners tuning in.
Yes.
It shows profound command of both the legacy markets and the on-chain environment.
This approach allows the audience to instantly feel the mechanics in their bones.
Yeah.
When you combine that stylistic translation with a solid causal hierarchy and a balanced integration of risks, the underlying data finally has the narrative vehicle it deserves.
It really does. All right, let's do a quick thematic recap of the core actionable suggestions we've outlined for this script.
Let's do it.
First, abandon the strategy of isolating all the risks at the very end of the document.
Definitely. Integrate specific vulnerabilities like the potential for Layer 2 fee cannibalization or the governance risks around staking yields directly into their corresponding catalyst points. This approach neutralizes audience skepticism in real time, preventing that shadow argument from undermining your credibility.
Right. And second, move away from a flat, parallel list of bullish drivers. Build a pyramid of causality.
The pyramid. Establish a clear hierarchy by framing the institutional ETF demand as the primary engine for 2026 price action, and explicitly connect the protocol upgrades and the deflationary tokenomics as the mechanical infrastructure that makes that ETF demand so mathematically explosive.
Yep.
Frame the on-chain utility as the foundational gravity that forces traditional finance to participate.
And finally, follow through on the promise of an engaging tone by anchoring the heavy on-chain jargon with vivid, real-world financial analogies.
Yes, please.
Move beyond reciting statistics like high beta or base fee burn. Describe a high-growth tech operating system executing a programmatic algorithmic share buyback while simultaneously paying a native dividend. Use the traditional framework to get them in the door, and then show them why the algorithmic version is superior.
The foundational research and the data compilation in this material are exceptionally strong. Now it is just about refining the architecture so that the brilliance of that research can translate into a persuasive, memorable argument.
Absolutely. We highly encourage you to apply these structural and stylistic changes, weave those risks into the narrative, build that causal hierarchy, and submit the revised material back in for another critique. We would love to see how this analysis evolves.